I'm not going to gloat. I'm not going to gloat, but it was fun to watch. I feel sorry for all the Boston fans out there, I guess, kind of. It's a good team, and I think there's some feeling that the Warriors, the team itself, nobody's getting any younger, right? And so this might be really their last hurrah, but they do have some rising stars. But yeah, to watch Clay's come back after being out a couple of years and watch Steph Curry and just I always marvel at the fact that the other team pretty much knows what he's going to do. He's gonna wind around, he's gonna run through the key, he's gonna run over here and run over there, and they somehow get him the ball, and then he somehow gets these shots off, and he ends up scoring 30 or 40 points, despite the other team knowing the plan. And here they are playing the Celtics, and the Celtics know they know the game, they know what's going to happen, and they can't stop it. And when he gets through and does some of these layups, you think, what the heck,
It reminds me of the Jordan years in Chicago. Everybody knew what was going to happen once they threw the ball up, and it still happened.
Right. Yeah. So the victory parade is Monday morning or Monday afternoon, and the guy my daughter is dating is going to go. I don't know. I don't think he's in the parade, but he's definitely going to go. He does video editing for the Warriors, so he's excited about that.
Very nice. Well, we were talking before the series, a lot of the advanced stats and the too cool for school analysts. A lot of them were Golden State was a minus 160, 170 favorite to win the series, and a lot of the advanced stat guys were saying they got it wrong. Like Boston should be favored, but then you heard kind of the basketball people say, well, you got Steve Kerr versus a rookie coach. And how often does the team that wins the NBA finals not have the best player on the court? You really start to think about that and think about champions. Almost always the NBA champion is the team with the best individual player. And we certainly saw that this last week. So,
yeah.
Good stuff. Well, happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the Rundown with Rob and Rich, where we take you into the weekend by running through all the latest, greatest, the week that was with the mortgage industry, another wild week for our industry, and excited to get into the banter. As always, as I am each week, my esteemed colleague, co-host, Rob Chrisman. Rob, welcome and congrats again on your Warriors.
Thank you. Good to be here.
And then this week, we've been talking so much just about rates and government policy as it relates to housing and inventory and supply, obviously huge issues our industry and housing and the U.S. economy faces more broadly. So decided to bring on an actual expert this week as opposed to me, Rob, and I, our continual dart throws. So very pleased this week to introduce in the co-pilot seat a non-resident fellow at the Urban Institute, also owner of Parrot Advisors, advisory firm that gives their clients strategic advice on housing finance issues. And before that, a senior advisor to the National Economic Council, where he was really charged with leading a team of advisors that would counsel President Obama and his cabinet on housing issues. Jim Parrot. Jim, thanks for joining us.
Thank you. It's good to be here.
Awesome. Let's go ahead and get into it. And Rob, can't start any other way than talking about the Fed meeting this week and everything that kind of swirled around it. You go back to last Friday, our show, a hotter than expected CPI number after some numbers that looked pretty good, kind of freaked people out. Stocks tanked into the weekend. Treasuries and other fixed income assets started selling off. Get into Monday, the Fed assuredly leaks to the New York Times that they're now thinking about 75 basis points, causes all the markets to go crazy. Fed meets this week. They do indeed raise 75, which hadn't really been talked about mainstream until recently. Pretty much intimate they're going to raise 75 again in July. And we see 30-year fixed rates come back a little bit down now last couple of days. But the biggest jump up after jumping up these last 5 months, in 35 years, 10-year going all the way up to 3.5% from 295 over the course of a week. So wild week. Your thoughts on the Fed rates and all that madness?
All in 30 seconds or less. So it was interesting leading up to the Federal Reserve, the FOMC's meeting this week, because so many Fed presidents were out there talking about 50 basis points, 50 basis points, 50 basis points. But the inflation data that we've seen recently has really taken I won't say taken the Fed by surprise, but or tied their hands necessarily, but they're definitely in a reactionary mode to be focused on controlling inflation and trying to stop that march onward versus all this talk about growth and the possibility of recession. So really the Federal Reserve apparently felt they had little other choice than to bump up the target Fed funds rate by 75 basis points. And you're right, now they're talking about another 75 basis points. The mortgage rates that I'm seeing on rate sheets definitely in the high fives, if not low sixes, depending on loan level price adjustments. The pool of potential refi candidates, is at I won't say an all-time low, but it's plummeted with this move up in rates. And so the lenders that I've spoken with this week really, one person used the term nuclear winter in terms of business coming in the door. And the independent mortgage banks are grappling with credit unions and banks offering some intermediate ARM rates that are still in the high threes or low fours. And it's very difficult for an independent mortgage bank to compete with the credit unions and with the banks at those kind of rate levels. So the volatility has really hurt a lot of lenders out there. And, eventually we'll kind of settle in here, but really you have a lot of people talking about affordability disappearing for people, including first-time home buyers. The talk about affordable housing has kind of left the building to some extent. And so I'm especially interested in hearing Jim's take on all of this turmoil and all of this, interest rate movement and what impact that has in terms of housing policy. What's a good way for lenders to think about the economy and the move in interest rates and how it impacts housing policy, Jim?
Yeah, I mean, the administration really going back well into last year has been almost overwhelmingly focused on the supply problem, right? So they're very concerned and have been for a while about the balance between supply and demand that goes back, quite a ways now, for a couple of reasons. One is they're deathly afraid of inflation. No surprise at this point. They're worried about the politics and the economics of it. And roughly a third of the CPI that most use to measure inflation is from housing costs. It comes from rent and home prices, and much of the upward movement in home prices is coming from supply constraints, and so the administration has really been focused on what they can do to try to ease those constraints. And then the second reason they're focused, all of this pushes them to focus on the supply problem is, as you mentioned, it's such a problem for affordability. So rising rents, it's draining savings for renters, among whom are some of the more vulnerable folks in the country. And then rising home prices combined with rising rents makes it hard for folks to move from the rental bucket over into the homeownership bucket. And so they really struggle with what to do on the supply side. And then on the relatedly, back when I was on the inside advising on this stuff, we were all in on demand, right? At that point, you had like an inversion of what we're dealing with now. You had a supply overhang, you had a collapse in demand. I mean, every chart that you're looking at now with supply doing this and demanding that, it was all flipped back then. And so everything we were doing was focused on shoring up demand and trying to find a way to reduce the supply pressure that it was putting on prices. And so there's a pretty good toolkit for demand side help. You know, we kind of know down payment assistance, you know, easing pricing, the things the Fed can do to juice demand in a situation in which that's what you need to help. Helping on supply is just a lot harder. You know, it takes a much longer time to get supply help into the market. You know, even if they were to wave a magic wand and do something today to change the economics of building entry-level housing, you know, maybe you see units affected by that, you know, a year or two down the road, but they don't happen tomorrow. And so the administration's really, to the degree the White House and that level of folks in the administration are focused on housing, it's almost exclusively on trying to deal with the supply-demand imbalance.
So I wanted to ask you, and I've made this point on the show many times. It's one thing for the administration or any administration to make a proclamation, to talk about, we need more affordable housing. We need to help first-time homebuyers. We need, you know, communities to do this, that, and the other thing. And then by the time that trickles down into a community, you know, Jim, you know, if I've saved up my whole life and I bought my wonderful home here in the suburbs, I don't want, you know, 80 units of affordable housing going in a half a block away, because I you know, this is my nirvana, you know, here I am kind of thing. And so when you are talking to lenders about how to think about affordable housing and what the administration might want done, what are you seeing in terms of communities, in terms of counties and cities and states, and how they're reacting to that? And if you're a lender, what should you watch for in terms of affordable housing, you know, being promoted by the administration?
Yeah, so they're focusing on a couple of things. One of which is sort of at the community level, and I'll come to that in a second. But one of the areas they think they can make a difference in is expanding access to financing in segments of the market that suffer from not enough on the supply side. So I'll give you a couple of examples. So one of the problems that the construction industry's faced going back now since the last crisis is access to construction lending. Right, you got big guys that have access to liquidity. Small and medium-sized builders have largely lacked it, so their capital is more expensive, and that makes the math of construction, especially at the bottom of the market, hard, sometimes prohibitive. And so one of the things that the administration's done is they're pushing Fannie to develop a pilot to provide construction to perm lending. So basically, a secondary market for loans made presumably by banks to builders before they've got a building up. Historically, Fannie only, you know, buy loans that are collateralized by an actual building, and so they're trying to get Fannie to entertain the notion of beginning, you know, liquidity a little earlier to make the math better for small, medium-sized guys. They're also expanding financing for manufactured housing and ADUs and some other sort of niches that have long suffered from a lack of financing. But at the community level, this may ultimately be more important, that arguably the biggest impediment to supply going back now quite some time is local decision making, right? It's zoning, it's impediments to density in certain communities like the one, you know, you just mentioned. You don't want to have, you know, a high rise, you know, halfway down your block. And even if communities are allowing construction sort of in their, you know, in metro areas, the permitting costs and the like are such that oftentimes the math doesn't work, certainly at the bottom end. But these are all local decisions, so it's hard for the feds to wave a magic wand and affect such a local decision-making sort of issue. So what they're trying to do is change the incentives for communities to reconsider how they think about zoning, how they think about this issue. And the way they've done this is a few weeks ago, they announced a whole host of things that are intended to solve this set of problems. And the most interesting piece of it is they're taking some segment of the transportation part of the infrastructure package that was passed earlier this year, and they're going to tie how that money gets allocated to how communities handle their zoning. So if you're a community that for all intents and purposes prohibits the construction of density, in areas where we need affordable housing, you're going to get less of that money than if you're a community that is more inclusive in how you think about zoning. And the reason why that's interesting, it's not a big number early. I forget the number of billions of dollars that are in play, but because they're beginning to tie DOT funding and considering tying some HUD funding, so federal funding that's going to these communities anyway, to how communities think about their zoning. It might be the kind of federal hook into this issue that they've lacked for decades, frankly. And so it'll be interesting to see whether or not communities are responsive. I mean, those communities that are really dug in on this, it doesn't matter how much money you throw at them, they're not going to change their minds. But there are probably communities on the margins where the votes have been close, at the town council level, historic commission level, and this might be enough to sort of tip them over. But the administration is really struggling to figure out a way to put federal hooks into what's a pretty localized problem, because they've come to realize that in some ways the localized nature of this is the most important piece to the puzzle. And so they feel like if you want to fix what's become a national problem, they've got to find a way into to that local decision making somehow.
What about obviously lenders on the call here they deal with Fannie Mae, Freddie Mac, they deal with FHA and VA and HUD and Ginnie Mae, et cetera. What are you seeing at the investor level in terms of pricing that might impact, affordable housing or housing policy in general? What are lenders seeing out there now?
You mean pricing, investors coming in and buying up properties? Is that what you mean by investors?
Yeah, well, let's start with that. Sure. I know that, so in my commentary today, I know that the Atlanta mayor has thrown out the suggestion that Atlanta limit the number of investor-owned properties in Atlanta, which to many smacks of, well, I don't know, government control or socialism, right, whatever you want to say. So yeah, let's start with that aspect of it.
Yeah. So it's an interesting, I think, really complicated issue. So to clarify at least what I think of when I am answering this question, the challenge that has come up is you've got an increasing amount of investor capital that is increasingly well organized and well structured, for lack of a better way to put it, in investing in single family rentals, basically. So that they have moved into certain segments in the country, not all. It's a very lumpy sort of investment strategy. They tend to focus on certain communities, not all, but where they have focused, you've seen the Blackstones of the world, invest in communities and buy up, often in bulk, properties in a way that makes it hard for owner occupants to compete. If you're a first-time home buyer, want to be a first-time home buyer, and you're going to put a bid in on a house, and you're already facing a bunch of others that, say you've got an FHA loan, or you think you might have an FHA loan, you're already facing some others that may have a GSE loan, which they can turn around a little more quickly, or heaven forbid are going to offer in cash. So you're already sort of you're already a little behind the eight ball. If you wind up facing an investor that's willing to pay a premium because of their cost of capital being different than yours, and being willing to pay in cash, it's just hard for you to put up much of a fight against an investor that's got those resources and can move that way. And so, repeatedly in some communities, the investors winning those bidding wars over and over again, and so that's created some frustration. And then to make it more complicated politically, you got a lot of folks that are looking for a bad guy in this, saga right now. And when you put, private equity and Wall Street capital into the equation, it creates a political narrative that's easy to point at somebody and blame for all the lack of affordable housing. That oversimplifies the situation a fair amount. You've got some of these investors that have actually teamed up with builders who are actually increasing overall supply. So you're getting builders who are building supply just for this purpose. So the story is a little more complicated than that. I think the numbers nationwide, depends on what numbers you look at, but these days investors are buying up, anywhere between 8 and 15% of the market. That's probably misleading because most of their resources are being allocated to a finite set of communities. So that number tends to be either higher or lower. The national number tends to be misleading. So I think the investor issue is probably relevant in a small number of communities across the country where you're getting up into the a quarter of the market's being consumed by investors. I do wonder if the math's going to work for them as interest rates keep rising and this this big gets more mathematically challenging for these guys. So it may be that the economics of all this begins to solve the problem for us over the next 6 months. But what I would say is between now and then, the easiest answer for communities is to make it political and to say things like, we're going to put a cap on it. You're not going to be able to have more than X investors owning properties in your neighborhood and all of that. Because it puts a bad guy's face on a problem that's a lot more complicated to solve than that. So the politics of this aren't going to ease anytime soon, but the economics might.
Right. So lenders tuning in have had to deal with pricing fluctuations from the FHFA via Fannie Mae and Freddie Mac in terms of second homes, but also in terms of investor properties. Which brings up the question about Fannie Mae and Freddie Mac and their role and so forth. And some years ago, leading up to, let's say, throughout the Trump administration, GSE reform was a big topic out there. Recapitalize and release, and so let's let them retain their earnings, and then at some point, release them into the into the wild and see how they do, and that's where they should be and so forth. They don't belong under government conservatorship and so forth. And with the Biden administration coming in, it seems like the talk of GSE reform has I'll say it almost has disappeared. It seems like Sandra Thompson coming in and so forth, and just so you know, Sandra has spoken a couple times to the Mortgage Collaborative group here, but it seems like talk of GSE reform has been replaced by talking about, once again, affordable housing and first-time home buyers, and really focusing in on home ownership rather than investor properties or second homes and so forth. Where, from your perspective, where is the GSE reform movement now, and what should people on the call?
Yeah, man, there's a lot there to unpack. I think that so right now the administration, at least at the White House Treasury sort of level, they are really focused elsewhere. They're so worried about inflation and worried about all these other in some cases related economic issues. They're not putting a lot of bandwidth into this issue. They see the housing market as is not a fire they need to spend much political capital putting out relative to at least other fires. And so the significant bandwidth it takes to actually have a meaningful conversation about GSE reform, and it is all consuming. I mean, we were in the same place the last administration was in the Obama administration. We spent God knows how many hours debating what form the GSE should take and how to get from here to there and all that, as did the last administration. It is an all-consuming effort once you get into it, and these guys have other all-consuming efforts that are taking up their time. I think in the meantime, Sandra and to some degree the rest of the administration are really focused on trying to find ways to ensure that the GSEs and FHA are serving sort of the broader housing agenda that the administration has. So less focused on getting the GSEs to some other structure, getting them out of conservatorship, and more focused on how do you make sure that they're stable and playing the role you want them to play today. And the way to translate that to the investor property, mission focus discussion that you were alluding to, if you think about pricing for a minute, which is where you started the comment, which is directly relevant to all this. The way that Sandra thinks about, and this FHFA thinks about pricing is sort of think about the GSE's business is broken into three categories. One is the mission category. So, affordable housing, goals, duty to serve, some cases, first-time homeownership. And then the other end of the spectrum is more sort of mission remote. So investor properties, maybe high balance lending, second homes, that kind of thing, maybe cash out refis, there could be a debate there. And then the rest is kind of the core business. It's just, plain vanilla, 30-year fixed rate purchase, rate and term refi. And so they sort of divide the world into those three channels. And what they're trying to do with their pricing, which is an indication of how they view the role of the GSEs generally, is how do you maximize the pricing in that mission remote bucket? That is the bucket where the argument for having the government support or lean in to support markets is maybe not as strong as it is on the mission side of the business. How do you price that up in a way that maximizes the profits that GSEs can make without losing the business? So you don't price it up so it goes goes to banks or whatever, you keep it within the footprint, but you increase pricing enough so you've got enough excess profits, as it were, to turn around and use it to reduce pricing at the other end of the spectrum where they think their mission is strongest. And you saw them do a little bit of that with second homes and high balance lending a while back when they moved up pricing. They had already done it with investor properties where the pricing was already pretty high. So I think the pricing there is already kind of at the edge. I think they're of the view that if they went much farther, they might actually begin to lose market share. I think there's a good chance you'll see cash out refi pricing go up a little bit because I think they've got a little room there to move before they lose market share. And then you'll take all of that additional, profit, as it were, and cut pricing probably pretty significantly at the mission end. So I think that's probably coming in the next few months. But the reason why I mention it is that's the kind of thing they're focused on right now. They're not focused on, getting the GSEs to a place where they can go out and raise, a couple $100 billion in capital to get out anytime soon. They're not looking at restructuring the regulatory regime so that they can better manage the GSEs once they're out. That's just not where their collective head is. Their collective head is on, how do you get pricing and the mission of the GSEs aligned with where, the administration is generally, I think.
I always am amazed when I think about the number crunching ability of FHFA and Fannie Mae and Freddie Mac to deal with trillions of dollars of loans and run the analysis in terms of, if we do this to non-owner occupied pricing, what is the impact? If we do this to second homes, what is the impact going to be on our volume and so forth? What we saw in terms of when COVID hit in March of 2020, so many private companies, and namely non-QM, non-agency, jumbo, backed out of the market, either mostly or entirely. And it really left a bad taste in lenders' mouths, because here they had pipelines of jumbo loans and non-QM, non-agency loans that were destined.
I remember,
yeah, for these companies. And suddenly, suddenly they went away, and they've since come back. From your perspective, in terms of government and housing and so forth, do you think that government officials and regulators understand how private companies can react to changes in the marketplace and the role that Fannie Mae and Freddie Mac, who never stopped buying loans, but do you think they understand the difference?
I think FHFA and the GSEs do. I think the rest of the administration, you got a lot of folks in the administration that are economists who are helping in housing. They're not housing folks, right? So they're not this level of nuance to those folks will be intuitive, but it's not something that they've got decades of experience knowing. FHFA, on the other hand, knows it at a pretty deep level because the GSEs know it at a deep level. So I'm pretty comfortable this is something they're sensitive to. I think to sort of put a fine point on it, when you think about pricing, so they will, if they really are trying to find the outer edge in these non-mission sort of segments or mission remote segments, that outer edge is going to move. It's not like it was handed down from the heavens, and once they figure out what it is, they can just land on it and call it a day. But once they push their pricing up far enough, you're going to have a bunch of sources of private capital that left a couple of years ago that think it's worth my time and effort and investment to set up an infrastructure, because pricing now makes a little more sense. And so you're going to see folks come in from the sidelines a little. And it'll change where the agency bid, that inflection point is. So the inflection point may be X today. And if they get all the way out there to X -1 or whatnot, you're going to see a bunch of banks and others that think, that the X isn't so bad. I could make some money if I start charging, X -1 or whatever. And so they'll begin to deploy resources to set up shop at that border. And the GSEs and FHA are going to have to be careful because at some point that line's going to move on them, and they are going to lose market share, even if they don't lose it tomorrow. At some point the market's going to move enough so that they'll get taken out in a way, and so they've got to be flexible enough to change what their pricing looks like in response to what the outside world's doing. And I mean, in this environment, people are going to be chasing margin, and you're going to have all kinds of folks that are willing to move at prices where they might not have been willing a year ago. And so, the GSEs are certainly going to be sensitive to that because they're not going to want to lose market share. And I think in the last administration, where there was more focus on getting the GSEs, frankly, smaller and more deeply capitalized and ready to go out, I think there would have been some risk that FHFA wouldn't allow them to lower pricing to hold market share, because they'd say, hey, if the private market's willing to come in at that price, who's the government to screw that up? I think this administration wants to cross subsidies so badly, they're not going to give that market share away nearly as easily, right? I mean, if they price themselves out of the market in all these mission remote segments, on the argument that sometimes you hear from progressives, it's a wrong-headed argument here sometimes, that we, the government, shouldn't be in the business of worrying about supporting investor properties anyway. But the reason why that doesn't make much sense is even if you don't care about investor properties in some social way, if what you care about are those that need a little help on their pricing, well, that money's got to come from somewhere. And right now it comes from the investor properties. It comes from the cash outs. And so if you lose that business, the subsidy you're going to allocate downstream to first-time home buyers and the rest, it's going to get smaller. And I think this administration, this FHFA gets that. And so I think they'll be reticent to let too much market share slip. That's not to say they won't screw up and price it in a way that ultimately proves to be overly aggressive. I mean, it's inevitable. It happens to other businesses too. The question is, how quickly can they correct course and move their outer edge back a little bit so they can hold on to the share they need.
Yeah, those are great points.
Absolutely. This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman. This week, really pleased to be joined by Jim Parrot, who is a non-resident fellow at the Urban Institute, owner of Parrot Ryan Advisors, who advises clients on housing finance issues, and longtime senior housing policy advisor to the Obama administration. Jim, fascinating points, especially some of the insight into how the GSEs look at pricing and pricing moves. And as always, any questions, comments anybody has for Jim, please feel free to put them in the chat or Q&A, and we'll incorporate them. And Jim, I'm going to rapid fire some questions at you that we've had come in and some questions I had. FHA mortgage insurance premium. Do you think we're going to see a reduction coming soon here?
Yeah, so I think this is an interesting area where the market doesn't fully understand where we are policy wise. So let me lay the table for you, and then I'll back into what I think is going to happen. So FHA, as a lot of your viewers will know, has a lot more capital, or at least implied capital, than they need. So their statutory minimum is about 2%. They've got, as of November of last year, 8%. It may be a little less than that now, but not meaningfully. So they've got a lot of capital headroom to move to cut premiums. And I think as a result of that, you've had a lot of people claim they ought to cut premiums pretty severely. The problem is they have priced into the administration's budget FHA's pricing of today. So if they cut FHA pricing by $1, somebody at HUD's got to give that dollar back in some other form. And so FHA, they're counting on, for budgetary purposes, the revenue stream that FHA is bringing in to pay for, a whole bunch of other stuff. And so if they reduce that revenue stream by half, they're going to have to go, take $1 billion out of the pocket of some other HUD program. And that's a pretty damn binding constraint. That may not be a binding constraint so much they don't do anything, but it means that if they do move, it will be much more modestly than I think folks expect. Because I think folks, and I was guilty of this at the beginning too, I think folks were doing their MIP math based on this 8% versus 2% difference, and you come up with some pretty wild numbers for what they could cut to spend that 6% capital buffer. But that's the wrong math. You're sort of looking at the wrong equation there. The math really is, where else at HUD do you think you got room to cut to pay for this, for this cut? And as I said before, they're really worried about supply side stuff. So you don't want to go cut a supply side program. Do you want to cut rental vouchers? The politics and economics of that are hard. So I think there's a chance that you might see a really modest cut in the coming months, but it'll be modest because of that budgetary constraint. I think what you're likely to see, whether they cut MIP or not, is a fair amount of throat clearing around, it's the budget's fault. We can't cut but so much because it's priced in. And you'll probably, I hope this is the case, this has been my advice to them, you'll get a little signaling that, look, when the next budget cycle comes up, as long as FHA's got the kind of capital cushion it's got now, we will cut MIP much more significantly, consistent with that, budget, that capital headroom we've got. And once we decide what we'll cut, we'll factor that into the baseline budget, and we'll have more room, and we'll be fine. But it means that deep cuts are not likely to happen until the next budget cycle, which means next year. So I think we're far off from a deep cut from FHA.
Do you think that and I know we're 6 months away from the election, but the press is already talking about it, and the press is talking about how the Republicans may see a resurgence in Congress. If that happens, Jim, do you think that will impact any of the things that we've been talking about on this call?
Yeah, so I think much of what's going on right now is administrative. It's regulatory agencies, it's the Biden administration, and those seats aren't going to change no matter what happens in Congress. I think what will happen is, if indeed you see power shift in Congress, which I think is a high likelihood, I think you'll see a lot more hearings on all this stuff. You'll see Sandra getting dragged up there and yelled at by whoever's running the Senate Banking Committee. And that'll make folks a little more cautious probably than they would be otherwise, because they know they're going to get dragged to the principal's office repeatedly and have to explain themselves. But at the end of the day, even if Congress flips, it'll flip at the margin. We'll go from a 50-50 split to maybe a 51-49, maybe a 52-48. Nothing's getting passed in that environment, so it's not like you're going to suddenly see a big wave of, a veto-proof legislation that's going to move the ball in some meaningful way. So what it'll do is it'll change what we're talking about, because the chairs of the Banking Committee and the House Financial Services Committee will change, and they will focus on different stuff, which means you'll see the administration having to defend itself on various fronts. But I don't think it'll meaningfully change the policy per se. I do think one thing that will change as we get into sort of the back half of this first term for the Biden administration is Well, two things. One, I do think they will eventually begin to focus on GSE reform a little bit, because I think it will begin to sink in that there's a lot of opportunity cost in not engaging with the GSEs a little more actively than they have been. And two, I think they'll realize that if they're not around for a second term, the next administration may take the course the last administration was taking, and may push the GSEs out in a way that will make these guys uncomfortable. So I think you'll see they will begin to focus on cleaning things up, in the last couple of years of their term. And then in Congress, and this is the optimist in me, this is the glass half full version. There's a fair amount of interest in some supply side legislation. I've talked to some members in the Senate, especially moderates, who really would like to put together a tax side package to help on supply side issues, plussing up LIHTC and the like. And they realize, these are Ds, they realize that it's going to be hard to pass anything heading into a midterm. It's just the politics are pretty prohibitive. But there's often historically a sort of honeymoon period between midterms and the next January, where outgoing policymakers would like to get something done before they leave. And you end up with small deals being cut. And there's no reason why moderate Republicans wouldn't be interested in a tax-focused supply-side package. So I've been helping folks sort of put stuff together sort of for that window, in the hope that we wind up with this, brief, window of competence from Congress where we can get something done. So there's a chance that you might see at the end of this year a window where small stuff gets passed. It's hard to know whether after January there's an opening where Biden is forced to the center a little bit, because now his dance partner's different, and you wind up with moderates in the Senate and the House willing to cut deals that might, get Biden's signature. That's the way it's worked in decades past. Recently, things are so toxic that there's reason to be a little careful about speculating too much about a period of bipartisanship. But you could imagine maybe next year seeing a bit of a move by the Biden folks to try to find some bridge there. I think in the year after that, we'll then be pivoting to a presidential election, and all bets are off. Everybody reverts to their worst fifth grade self on both sides of the aisle. So I'm not sure we'll see much then. But next year there might be a period.
Fifth grade at best.
IMB reform, Jim, led by Rocket. IMB is probably doing 70% of the mortgages in America. It used to be flip-flop banks, depositories doing that, led by the Wells and Chases. Seems like the government, federal government, is just generally a little uncomfortable with non-banks doing that much of the mortgage lending. There's been talk of, obviously the servicing capital thing from last year, and talk about CRA requiring anything coming for IMB.
Yeah, so I think the IMB stuff's fascinating, because on the one hand, you're right. Regulators have been nervous about the rise of IMBs. And their perception that regulators' perception that IMBs aren't regulated in the same way the banks are, and the Fed in particular has expressed consistent angst over all this. On the other hand, IMBs have stepped into a vacuum that the banks have left at places like FHA, and so you got to be careful with how you sort of drop the hammer on IMBs, given that they moved into this space for a reason, and it's not obvious to me that if they leave, somebody else is going to go fill that gap in a way that is going to make any of us all that happy as far as, lending to first-time home buyers in underserved communities. So I think they're aware of this. So they've got a bit of a complicated dance here between, slowly cranking up capital rules and counterparty rules for IMBs, but trying to do it in a way that doesn't scare everybody off. Such that the communities these guys care most about, are back in the soup, or they're not being served all that well. If you look at FHA's numbers, they're overwhelmingly being served by IMBs. You look at, Black homeowners, Latinos, IMBs are, all over those communities. And so if you pull those guys out too aggressively, you got a real access problem. But FHFA and Ginny did hear loudly and clearly the Fed's concern about all of this. And so they've gone back to look at their counterparty rules with IMBs in mind. So I do think in the next couple of months, you're going to see FHFA come out with, finalizing their seller servicer requirements, which have a real IMB sort of hook to them. I think Ginnie will do the same. Ginnie, under the last Trump's Ginnie, they had proposed a rule. I think the new Ginnie president, Elena McCargo, who's from Urban, an old colleague of mine, is sort of reassessing whether or not the proposed approach makes sense. Ginnie are trying to sync up with FHFA a little more than we've seen in the past. So my sense is you'll see over a few months, the two of them come out with issuer guidelines for Ginnie, seller servicer guidelines for Fannie and Freddie. They're hopefully, if not the same, because their problems are a little different. Ginnie's a different channel than Fannie and Freddie, at least synced up to the point where the IMBs are on the receiving end of both sets of these regulatory regimes, aren't dealing with tension between the regimes. FHFA is focusing mainly on a liquidity risk. They saw back in March of 2020 how borrowers quit paying their mortgages. Banks began to get a little nervous about their warehouse lines, and we all got a little nervous about whether or not bond investors were going to get paid. So you ended up with this collective dis-ease about what was happening in that channel. I think FHFA realized that that's less a solvency issue in the way that you would worry about with banks, and more of a liquidity issue, which is making sure that IMBs have got access to capital to fill the gap when borrowers aren't paying at the rate that they were before. It's good that they're doing that, because addressing liquidity risk is a hell of a lot easier than addressing solvency risk. And so I think you'll see added liquidity buffers and the like that will force the IMBs to hold a bit more capital than they have before, but hopefully not prohibitively more. They came out with a proposal a few months back that by and large makes a lot of sense. They probably went overboard here and there. They've got a big buffer now imposed on hedging positions, which is probably a little too much. They've got they no longer count as capital unused committed lines of credit. That seems a little aggressive. I can see why I wouldn't count it for 100 cents on the dollar, but zero seems a little extreme. So they're still trying to tweak the levers, but I think they'll land in a place that's probably pretty healthy over the next couple of months. Ginnie probably has a bigger change ahead of them. They, as I mentioned, had a more of a bank-like approach to this last time around. Basel-like approach where you got risk-based capital and minimum leverage ratio. My guess is they shift more in the liquidity risk direction in the way that FHFA has. If so, they probably reduce the binding constraint of that risk-based capital and add in some liquidity buffers instead. That'll take some more time, because that's a pretty different way of going about it than they had before. But all this is, feels like it's a later this summer, early fall kind of thing. They'll have a lot of time to implement this. I think the regulators are painfully aware of how much strain IMBs are under right now, and the last thing you want to do is add a back-breaking log to the load. So I think they'll give them a solid 6 months to come into compliance, maybe even longer if they feel like they need it. But it's hard. They regulators feel like they need to add more rigor to the counterparty regime. They realize that they should have done this last year, when everybody had more to spend on rigor than this year. And they realize that not only do you not want to lean in at a precarious moment, but you don't want to lean into a sector of the economy sector of the market rather, that's supporting exactly the kind of borrowers that you're bending over backwards to help. So they're in a tough spot.
Jim, we're just about out of time, but I got to ask you one more question. An issue we've talked about in this show for a long time. You talked about how it's hard to impact in the supply side of housing. We've talked about a plan for a while now. I think the stat I saw was 70% of the non-owners of non-owner occupied properties own between 3 and 10 properties. What about shoot holes in the plan where you would waive capital gains taxes for non-institutional owners of investment properties, incenting them to sell them essentially? I know there's something I'm missing, but it just seems like a win-win from a policy standpoint.
Well, you got to be careful they don't just sell to the big guys, right? You got to be careful that you're not taking the mom and pops, who people aren't all that worried about at this point. Although to your point, maybe they should be, because they're overwhelmingly the largest part of the market. You'd want to make sure that you I mean, I got to think about it.
The
Whether or not,
incentive, to be clear, was for the mom and pops.
no, I know,
Okay,
but,
all right,
right.
okay.
If you're releasing that supply onto the market, and I like that because the mom and pops typically own properties that are good for first time home buyers. Like there's a, it makes sense. They're at exactly the point in the market that is most undersupplied. You'd want to make sure that in doing that, you're not just setting up a supply channel for, invitation homes to come in and suck up, a bunch of inventory.
Yeah, it would have to be sold to an owner occupant.
Yeah, I mean, let me think about it. I mean, I like, because I've been focused on, and this is meant to be supportive of what the logic. As I talk to members of Congress and the administration, what I've said repeatedly is you've got to change the math for builders, right? Right now, the math for builders at the bottom of the market doesn't work. 1 + 1's got to equal 3. It doesn't, so they're not building at the bottom of the market. So, the easiest place to do that's with a tax code. I mean, there are other ways that might be more targeted, but tax codes, that congressmen can get their heads around that. But you're suggesting the same logic in effect for the mom and pops to sell in the market. There's nothing conceptually wrong with it. I have to think about it. Let me take that back with me.
Maybe we could have you back on, because it's been fascinating hearing your perspective on all these issues. And I really have enjoyed it. And I really appreciate you coming on and lending your insight.
Yeah, my pleasure. I've enjoyed it.
Absolutely. So let's do that. And Jim, I'll coordinate with you on a Friday coming up in the future. The fact you didn't shoot down my plan completely, it fills me with optimism, because
I'm a naturally positive guy. So
you're a
passive aggressive
guy.
I'll send you a long email after this explaining why it doesn't make any sense.
Right. I'm sure there's something we're missing, but really appreciate your insight. Rob, as always, enjoy the conversation every Friday with you, and congrats again to your world champion Golden State Warriors. So
yeah, thank you.
And
I had nothing to do with it.
And to our viewers, your daughter's, she's dating the video guy. Could add some impact. Yeah.
I don't want to talk about that, Rich.
And to our viewers, listeners, to our podcast listeners, where the majority of you consume the program, join us live on Fridays at 3 p.m. Eastern. Go to mortgagecollaborative.com. You can find the link to register for the live broadcast. We'll keep making these in the podcast. You can also find us on YouTube. And then, of course, we're here every Friday live at 3 p.m. Eastern with the Rundown with Rob and Rich. Thanks again to my co-host, Rob Krisman, and to Jim Parrot for spewing some knowledge and perspective on our audience today. Thanks again, Jim.
All right.
All right. Have a great weekend, everyone. Until next Friday, have a great weekend and a great next week. Take care.
Bye.